Well, good morning to everyone, and thank you very much for joining us for the 2023 NAIC International Insurance Forum. Welcome to the nation's capital. As you can see out the windows, a beautiful day. I'm Gary Anderson, the Commissioner of Insurance from Massachusetts and Chair of the NAIC's International Relations Committee. I do want to take just a moment and to thank our NAIC International team before we kick this off for all the work that is put into this. It's a pretty massive effort to put this together, and very much appreciate, led by Ryan Workman on the international team. Thank you very much to each of you, so a round of applause. So I have been told that I need some new material for these events. So like any normal person, I went to ChatGPT. And I have confirmed and actually feel validated because insurance is not funny. It clearly did not recognize that the butt of every joke should be Andy Mays. So I have some training on ChatGPT to do. But in all seriousness, thank you for joining us. We have a full agenda over the next day and a half for our flagship event here in DC. And to kick things off for this year's forum, I'm really pleased to introduce this morning's keynote speaker, the Honorable Philip N. Jefferson, Governor, Board of Governors of the Federal Reserve Board, who will be speaking to us about the board's economic outlook. Dr. Jefferson took office as a member of the Board of Governors of the Federal Reserve System on May 23, 2022, to fill an unexpired term ending January 31st, 2036. Most recently, Dr. Jefferson was Vice President for Academic Affairs and Dean of the Faculty of the Paul B. Freeland Professor of Economics at Davidson College. Before that, Dr. Jefferson served as the chair of the Department of Economics at Swarthmore College, where he was the Centennial Professor of Economics. Prior to this position, Dr. Jefferson was an economist at the Board of Governors of the Federal Reserve System. And Dr. Jefferson's other past roles include being president of the National Economic Association. He also served on the Vassar College Board of Trustees and the Board of Advisors of the Opportunity and Inclusive Growth Institute at the Federal Reserve Bank of Minneapolis. Dr. Jefferson received a BA in economics from Vassar College and a MA and PhD in economics from the University of Virginia. So won't you please join me in welcoming Governor Jefferson.
Good morning, everyone, and thank you for inviting me to speak. It's a real pleasure for me to be here, and I'd like to use this opportunity to share with you my outlook for the U.S. economy, credit conditions, and monetary policy. Before I start, let me remind you that the views I will express today are my own and not necessarily those of my colleagues in the Federal Reserve System. Despite heightened uncertainty due to banking sector stress, geopolitical instability, and the aftermath of the pandemic, I expect the economy to grow in the second quarter. The pace of growth, however, will be slower than what we observed in the first quarter, when real GDP increased at a rate of 1.1%. My expectation is based mainly on data that showed weakening spending in recent months and other data that imply moderating spending, including a sizable decline in April consumer sentiment as measured by the initial estimate of the University of Michigan surveys of consumers. While my base case forecast for the U.S. economy is not a recession, I expect spending and GDP growth to remain quite slow over the rest of 2023 due to continued tight financial conditions, low consumer sentiment, and a decline in household savings that had built up after the onset of the pandemic. Furthermore, I acknowledge that there are downside risks, among them the possibility that the degree of bank lending restraint and uncertainty could weigh on economic activity more than I expect. Even as GDP growth has slowed, employment has continued to increase, and the current labor market is one of the strongest that U.S. workers have experienced in decades. The economy created 253,000 jobs in April, and the unemployment rate was 3.4%, the lowest since 1969. Job creation has been remarkably resilient to tighter financial conditions. Employers have added an average of 280,000 jobs a month this year. That's down from 350,000 a month created in the second half of 2022, but still robust. The tight labor market has boosted wages and other compensation for workers. Wage growth has continued to run ahead of the pace consistent with 2% inflation and current trends in productivity growth. Wage gains are welcome as long as they are consistent with price stability. Over the 12 months ending in March 2023, the Employment Cost Index for totally hourly compensation for private sector workers rose 4.8%, down only a little from its peak of 5.5% last June. My expectation is that the slowing economy will soon begin to reduce job growth, with labor supply and labor demand coming into better balance. The unemployment rate may rise gradually to levels still consistent with a growing economy. Data on job openings and voluntary quits by workers indicate that labor demand has eased somewhat, and this is reflected also in a modest decline in the growth of average hourly earnings from a 12-month rate of 5% in November to a 4.4% in April. Now let me turn to the outlook for inflation. While inflation has come down substantially since last summer, it is still too high, and by some measures, progress has been slowing. After peaking at a 12-month rate of 7% last June, personal consumption expenditure inflation fell to 4.2% in March, which is also down from 5.1% in February. That reflects substantial decreases in energy prices and a big slowdown in food inflation. Cheaper energy and a slowdown in food prices are good news for lower and middle income households that spend a larger share of their income on these items. But outside of food and energy, the progress on inflation remains a challenge. Excluding these prices, which tend to be more volatile prices than other goods and services, leaves what we call core inflation. And this measure is a useful guide to discern longer-lasting movements in inflation. Core PCE inflation was 4.6% in March, down from a peak of 5.4% in February of 2022. While we do not have a report on PCE inflation for April yet, another inflation measure, the core component of the Consumer Price Index, showed little further improvement in April. Looking more closely at core inflation, I like to divide it into three parts. Core inflation, core goods inflation, housing, which is classified as a service, and non-housing services. Core goods inflation fell sharply over the second half of 2022 as supply chain bottlenecks eased, but more recently, it has stabilized at around 2.6%. Housing services inflation, which includes rent and the equivalent for owner-occupied homes, is 8.2% on a 12-month basis. Housing is a big part of inflation, and while rent increases on new leases have come down considerably over the past year, it will take some time for this softening in rents to show through to 12-month changes. And finally, inflation in non-housing services, the largest component of services, has been stubbornly high at around 4.5% and shows no signs of significant decline yet. Overall, the U.S. banking system is sound and resilient, and I am confident that it will be able to continue to play its important role providing credit to households and businesses. Nonetheless, it is reasonable to expect that recent stress events will lead some banks to tighten credit standards further. The evidence is that so far, there's only been a modest incremental tightening of lending conditions, which had already tightened considerably over the past year since the Federal Reserve began raising interest rates. In a survey conducted by the Federal Reserve in April, loan officers reported that 46% of banks had tightened credit terms in the previous 3 months for commercial and real estate loans to larger firms, versus 44.8% that had tightened in the January survey. The April survey's increase in the share of banks reporting tightening was similar, though a bit larger, for commercial and industrial loans lending to smaller firms. At this point, it is hard to tell how much of this tightening was in train already after continued increases in interest rates, and it is likewise difficult to say how much of the stress in mid-sized banks will ultimately curtail credit in the coming year. Furthermore, there's considerable uncertainty about the magnitude of the impact on household spending and business investment, and this uncertainty complicates economic outlook forecasts. Given your gathering here today, I would be remiss if I didn't say a word or two about the insurance industry before closing. The insurance industry has performed well through recent stresses. Although the profitability of property and casualty insurance companies in 2022 was reduced by natural catastrophes and inflation, the industry's capital appears strong when considering a range of plausible stress events. For life insurers, the recent increase in interest rates has been a mostly welcome development that has supported higher investment returns, but also poses risk, such as early withdrawals by some policyholders. While the life insurance industry's capitalization remains strong, the use of reinsurance merits continued monitoring. With that, let me turn to monetary policy. So, what factors will I consider in coming weeks as I contemplate the appropriate stance of monetary policy going forward? Over the next few weeks, we will receive a considerable amount of data on economic activity for April and May, including the employment report for May and a report on May CPI inflation. Monetary policy should be forward-looking. It should be conducted so that longer-term inflation expectations are well anchored around our target of 2%. Monetary policy should be data-dependent to allow for continuous learning about the underlying structure of the economy as new data arrive. These principles of monetary policymaking are always valuable, especially so when the level of uncertainty is high, as it is now. I am guided by the dual mandate assigned to the Federal Reserve by the U.S. Congress: price stability and maximum employment. On the one hand, inflation is too high, and we have not yet made significant progress in reducing it. On the other hand, GDP has slowed considerably this year, and even though the effect has been muted in the labor market so far, demand clearly has begun to feel the effects of interest rates that are 5 percentage points higher than they were a little over a year ago. History shows that monetary policy works with long and variable lags, and that a year is not a long enough period for demand to feel the full effects of higher interest rates. Another factor weighing on my thinking is the uncertainty about tighter lending standards that I mentioned earlier. I intend to consider all of these factors in the coming weeks as I contemplate the appropriate stance of monetary policy going forward. Thank you.
Thank you very much, Governor Jefferson. We appreciate the timely remarks and the time that you've spent with us here this morning.